friends, Investor Katta is growing fast. I want to thank all our subscribers from the bottom of my heart for your support. In our last video, I discussed about basic fundamental analysis of stocks. If you have not watched that video yet, I would strongly recommend you to watch that video, whose link is right here and also in the description below. Basic fundamental analysis of stocks helps us to identify potential investment opportunities. But it is not enough to make investment decisions. We must all remember the famous quote by legendary investor Warren Buffett. Price is what you pay and value is what you get. Market capitalization is the total value of outstanding shares of a company. It does not necessarily reflect the actual worth of the company. Share prices can fluctuate over short term due to reasons such as new product announcements, product recalls, public opinion on change in management, or political change. If the number of people who want to buy a stock is higher than the number of people who want to sell a stock, then the stock prices goes up. So, an increase in stock price does not necessarily reflect actual good financial performance. There are different methods to identify whether the price of a stock fairly reflects its financial performance. In this video, we will discuss about different methods to find whether a stock is undervalued, overvalued, or fairly valued. Before we start though, if you are new to our channel, please consider subscribing to get notified whenever we upload a new investment related video. So let's get started. Ideally, we want to invest in stocks that are undervalued or fairly valued to minimize the risks and maximize the returns. In this video, I am going to discuss some important ratios that can help us to identify whether a stock is undervalued, overvalued, or fairly valued. The first ratio we will discuss is the price to sales ratio, also known as the PS ratio. PS ratio is the ratio of market capitalization to total revenue. If the PS ratio is lower than 1, the stock is likely to be undervalued. Whereas if the PS ratio is greater than 1, the stock is likely to be overvalued. The next important ratio that we will discuss is the price to earnings ratio, also known as the PE ratio. PE ratio is the ratio of market capitalization to the net income. PE ratio can also be calculated by dividing share price by earnings per share, that is EPS. It is trickier to use the PE ratio to analyze whether a stock is overvalued or undervalued. One of the ways you can do this is by comparing the PE ratio of a company to the industry average. I like to compare the PE ratio of a stock with the historical industry average. Of course, if the PE ratio of the company is higher than the industry average or historical industry average, it might be overvalued. If the PE ratio of a company is lower than the industry average or historical industry average, it might be undervalued. Of course, if a company is not profitable, that is, if its net income or EPS is negative, the PE ratio has no meaning, and thus for early stage growth companies, the PE ratio is not a great indicator of the fair value of the company. The third most important ratio to analyze the valuation of the company is the price to book ratio or PB ratio. PB ratio is the ratio of market capitalization to the book value of the company. It can also be calculated by dividing the share price by book value per share. The book value of a stock is nothing but the difference between its total tangible assets and its total liabilities. If the PB ratio is lower than 1, the company might be undervalued. Whereas, if the PB ratio is greater than 1, the company is likely to be overvalued. According to my opinion, if book value or book value per share of a company is negative, it's a big red flag for investing. It indicates that the company's liabilities outweighs its total tangible assets. This is a huge risk, and I usually stay away from such risky investments. Now, if a company is undervalued or fairly valued with good gross margin, good net margin, excellent return on equity, low capital to expenditure ratio, I try to understand why it is undervalued. One way of doing this is by qualitative analysis, which I have discussed in detail along with concepts such as gross margin, net margin, return on equity, etc. in detail in the first part of this video, which I have mentioned earlier. So, do check out that video for a more detailed explanation. The link is in the description below. Another way to find why a stock is undervalued is to check debt to equity ratio and liquidity ratios. The debt to equity ratio is nothing but the ratio of total debt to shareholder equity. Shareholder equity is the difference between the total assets and total liabilities of a company. Several companies with high debt to equity ratios end up going bankrupt, and thus high debt to equity ratio indicates poor financial health. So even if a company has low PB ratio, low PE ratio and good margins, I prefer to stay away from such risky investments. Personally, I would prefer to see debt to equity ratio much lower than 1 to invest in a company. Liquidity ratios such as current ratios and quick ratios measure a company's ability to pay off its short-term debt. The current ratio is a ratio of current assets to current liabilities, whereas the quick ratio is the ratio of liquid assets to current liabilities. These two ratios should ideally be larger than 1. Now, let me summarize the important points from the two parts of this video. 1. I use fundamental analysis to identify good investment opportunities. 2. Fundamental analysis can be qualitative or quantitative. 3. Important points I check from income statement are steady growth in net income, good gross margin and good net margin. 4. Important points I check from the balance sheet are steady growth in retained earnings and good return on equity. 5. Important points I check from the statement of cash flow are the capital expenditure ratio and augmented payout ratio. 6. Low PS ratio, low PE ratio and low PB ratio with high net margin, high gross margin, high return on equity and low expense ratio might indicate an undervalued company. But I prefer to stay away from such investments if the company has a very high debt to equity ratio. In this video and previous video, I discussed about how I identify an ideal investment opportunity. But investment opportunities are rarely so straightforward. Always remember, higher returns comes with higher risk. Low return investments such as fixed deposits pose a low risk, which is the risk of the bank going bankrupt. Fundamental analysis helps you to identify the risks associated with potential investment. Now let's consider an example. Company X with poor financial health announces a product which can exponentially grow its revenues and improve the financial health of the company in the long run. Now let's say the stock of the company can double in the next 5 years based on the new projections of revenue growth. The potential returns are very attractive. The risks associated with this investment is that the company might not be able to finance this growth due to its current poor financial health. Once you understand the potential risks, you can use one of the several forecasting methods to estimate the expected returns from the investment, and then you can make your own investment decision by comparing the potential risks with potential returns. This entire process might seem a bit too tedious, and especially if you are investing a small amount of your money, it's probably too exhausting. In such a scenario, I would recommend considering investing in either mutual funds or exchange traded funds, that is ETFs. We have already made a video on investing in mutual funds, whose link is right here and also in the description below. So do check out that video. We will be soon making a video on investing in ETFs. If you like this video, don't forget to smash that like button and share the video with your friends and family. Also, do leave your feedback in the comment section below. Also, this video is not a piece of financial advice. I just shared the process that I follow to find interesting investment opportunities. Thank you.